So in the last video, we talked about different types of prepaid adjusting entries, and those were all time-based adjusting entries. Prepaid rent, prepaid insurance, you record your entry based on the passage of time. That time period assumption we talked about, the months that have gone by are going to trigger those entries. Office supplies, however, is going to be a little bit different. Here's our first entry. The purchase of office supplies for $1,400. We're going to debit office supplies $1,400 and credit cash $1,400. But let's look at what happens next. Instead of saying it's been 3 months or 6 months, instead what happens is, regardless of how much time has passed, we are going to count how much is left in our supply closet. Someone goes in and goes and does all the math, calculates, we have $600 of supplies left. What is our entry here? Well, a lot of students, when they get this wrong, it's because they put this number in their entry, the $600 in their entry. That is rarely, if ever, the right answer for an office supplies question. The prompt is telling you the end of the story. You've got to fill in what happened between the beginning and the end. And here's what happened. Is office supplies expense, debit $800, office supplies credit $800. And so you can see, if we look at the office supplies account itself, this is our $1,400 amount. The purchased amount is our $1,400 amount. Next, we're given $600, which goes down here in the ending balance. What we are entering in this entry, this credit to office supplies, is what goes here, the amount used. So we're crediting office supplies, the asset account, for the amount we used, and then debiting expense for that same amount to record the fact that it was expense. That helped us this period. All right, revenues. Initial entry, received $5,500 in advance for services. As I look at the history of the class and look at all the exams, even on the 4th exam, 3 months from now, 2 months from now, depending on the pace of the class, you students are still not capturing, still not understanding, still not grasping that unearned revenues is a liability account. In this spot, we've been given money in advance. So we got $5,500 and we've done nothing to earn it. We cannot record revenues because we haven't done the work. Remember, the revenue recognition principle tells us record revenue when it's earned. Well, we haven't earned anything. This is a free lunch so far. And so we got our $5,500, but what we do have is we have a liability because we owe a service. We have an obligation to do the work or return the money, obviously, right? And so here's our first entry. Debit to cash, $5,500. Credit to unearned revenues, $5,500. So again, what we have here is not a revenue account. This is not a revenue account. This is a liability account. And so what happens once the work is done? We perform the service. Well, the revenue recognition principle tells us once the work's been completed, we record revenues. And so boom, that's what we do. We record revenues. And this $5,500 of unearned revenues, this liability, is gone. We don't owe the unearned revenues anymore. And so the unearned revenues go away. We credited $5,500 to create them. We debit $5,500 to say goodbye to the unearned revenues. All right, last item in this video is depreciation. And we're going to talk a little bit about this, and then we'll talk a little bit about the terms and things like that. But this first part should be okay for us. We're buying a truck for $12,000. Here's our entry. I debited equipment $12,000 and credited cash $12,000. You could have debited truck, you could have debited vehicles, you could have debited, there's honestly a decent number of right answers to what the debit is of this entry. I wouldn't get too upset with myself if I did not put that correctly. If you didn't put the same thing I did, at least. But the question is, what do we do going forward? If we spend $12,000 on a truck today, and we're going to use that truck for the next 2, 3, 4, 5, however many years, it makes sense to me, rationally and logically, that we're going to put a little bit of that $12,000 in each month as we go. And that's essentially what depreciation is. In this case, we're going to put $400 in each month. $400 of the purchase of that truck is going to get pushed into each of those subsequent months for depreciation. And here's our entry. Debit to depreciation expense $400, credit to accumulated depreciation $400. A couple things there. This is a new expense account we haven't talked about called depreciation expense. And it's a special expense just for this type of transaction. We buy a piece of equipment, it's going to last us a long time, and we depreciate it over the life of the asset. The second part of this entry is accumulated depreciation. Some of you might have thought that we should credit equipment here, or whatever you debited earlier. And that makes some logical sense. That's what we did with our prepaid rent, with our prepaid insurance, with our supplies, is we credited the actual account. Well, accounting rules tell us we want to keep that $12,000 in that equipment account so that we know how much that equipment originally cost us. So it's almost like we put that original equipment amount in a time machine and we leave it there. And then we keep it there until the equipment is actually sold, which we'll talk about in a later chapter. There is more depreciation coverage in chapter 9 or so, and we'll get into all the different methods of calculating it and all the different entries. For the purposes of this exam, you need to know this entry right here. This entry is all you need to know for this exam. You also need to know that accumulated depreciation is a contra asset account. It is a contra asset account. It's contra asset is basically opposite asset or offset asset. There's tons in your book about what a contra asset is. If you still have questions, ask your instructor. Also keep in mind, you might have a homework problem that asks you to calculate depreciation. It's a pretty simple formula. Look in your textbook for it and put the numbers in and move on with your life. That formula will not appear on this first exam. It will appear, however, on future exams. All right, so I promised you this earlier. I promised you a screen that kind of summarized everything that we're doing in this chapter. And this is half of that screen. Later in the video, I'm going to have the rest of this. You can see, obviously, there's a big gap over here. This is going to be filled in at the end of the last video. But this is what we've done so far. And so you ask a question at first whenever you're doing an adjusting entry. Is it a cash first transaction or a cash later transaction? In this case, it's a cash first transaction, otherwise known as a prepaid. And then you're down to a choice. Is this a prepaid expense or a prepaid revenue? If it's a prepaid expense, then this is your adjusting entry. Every adjusting entry, if you look at depreciation, supplies, prepaid rent, prepaid insurance, any prepaid item, the adjusting entry is always this: debit to expense, credit to an asset, either a prepaid insurance, what have you. If it's a revenue, there's just one type of those, and so it's really always this: a debit to a liability account called unearned revenues. That's what the UR stands for, and a credit to revenues. Now, feel free to use this while you work on this, which is Worksheet 1. Worksheet 1 has a good amount of transactions, and it's the ones we just went through: prepaid insurance, prepaid rent, supplies, depreciation, and unearned revenues. That's what's on Worksheet 1. I also throw in some older stuff from Chapter 2 too, just to keep you on your toes, but that's essentially what Worksheet 1 is. And again, I've said this before, and I'll probably say it every time I introduce a worksheet, is work the worksheet. Don't just look at the solution. The solution's there for you to use after you've attempted the worksheet. I am even okay with you, even if you have no idea what to do, look at the worksheet. Try. Just throw something at the wall and see if it sticks. First of all, you might know more than you think. And second of all, your brain responds better to that miss than it does to just looking at the solution. Thank you. We'll be back for more adjusting entries in the next video.